Right, let's start with the last couple of weeks, because the last couple of weeks have been something. On Thursday, 5th of June, $1.4 trillion was wiped from AI stocks in a single trading session. 1.4 trillion in one day. The Philadelphia Semiconductor Index fell 10%, Marvell dropped 17%, AMD fell nearly 11%, even Nvidia, the company that has become the face of the entire AI trade, fell 6% and briefly lost its $5 trillion valuation in the process. 1 week earlier, Nvidia had been the most valuable company on the planet, and in a single session, 6% gone. So, is this the beginning of the end for AI? Is the bubble finally bursting, or is this just the market doing what the markets do? Let's zoom out, because the sell-off isn't the first time this has happened. In January last year, a Chinese startup called DeepSeek released a competitive AI model reportedly trained for $5.6 million. On that news, Nvidia lost $588 billion in market value in a single day, the largest single day loss by any company in the history of the stock market. And then it recovered, almost completely, within a week. Meanwhile, Nvidia's return since October 2022, over 1,700%. OpenAI valued at $850 billion as of March 2026, more than most countries' entire GDP, on revenue of $13 billion a year, and a commitment to spend $1.4 trillion over the next 8 years. So, is this a bubble? Are we watching 1999 happen all over again, or is this genuinely something different? I'm going to give you both sides of this argument, properly, with real numbers, and then I'll tell you what I actually think. And more importantly, what any of this should mean for how you invest. Let's go. I'm Leo, and this is Financially Fit Millennial, where we take the complicated financial stuff and make it make sense. Today's video is one of the most important conversations right now in investing. Whether you've got money in Nvidia, whether you're holding index funds that are loaded with tech, or whether you're just trying to understand what on earth is going on, this one is for you. No hype, no doom, just the facts, both sides, and an honest take. Let's do it. Before we can answer the bubble question, we need to go back, because I think most people have a vague sense of the internet got too hyped, stocks crashed, bad times. But the specifics are wild, and they matter for what we're talking about today. The late 1990s, the internet is brand new. Everyone can see it's going to change everything. And they were right. It did change everything. But investors got so excited about the future that they completely lost touch with the present. Companies with no revenue, no profit, no real business model at all were being valued in the billions. Pets.com, an online pet food delivery company, raised $300 million in its IPO, burned through it in a year, and went bankrupt. It had a famous sock puppet mascot and essentially no working business. Cisco Systems, one of the most legitimate technology companies of the era, that was trading at over 200 times its earnings at the peak. To put that into perspective, if you bought Cisco at the peak of the dot-com bubble and held it for 25 years, you'd still be sitting on a loss today. That's crazy. Amazon, arguably one of the greatest companies of the past 30 years, saw its stock fall 90% from peak to trough during the crash. 90. If you'd bought at the top and sold at the bottom, you were devastated. If you'd held through it, you'd have made life-changing money, and we'll come back to that. The Nasdaq fell 78% over 2 years. It took 15 years to recover to its dot-com peak. So that's the benchmark. Now, how does AI compare? So let's start with the people saying, yes, this is a bubble. Because honestly, they've got a point. And recent events gave them a lot of ammunition. First, the concentration numbers are extreme. The 5 largest companies in the S&P 500 now account for 30% of that entire index. That's the most concentrated the market has been in 50 years, actually higher than the dot-com peak. The Magnificent 7 alone make up 37% of the S&P 500. If those companies have a bad week, and what we've seen previously, they have, the whole index feels it. That's a fragility worth knowing about. Second, there's circular financing happening that doesn't get talked about enough. Nvidia invests in OpenAI, OpenAI buys Nvidia chips. Nvidia invests more in OpenAI, OpenAI raises money partly on the strength of that partnership. The money flows in a loop between a small group of interconnected companies, inflating their valuations simultaneously. Third, and this is the big one right now, the spending is absolutely astronomical and the returns haven't fully materialized yet. The big tech companies are expected to spend somewhere between $660 and $690 billion on AI infrastructure in 2026 alone. Total projected AI capex from major tech firms between 2024 and 2029, over $1 trillion. That's the largest corporate investment program in the history outside of wartime. A respected economist, Ruchir Sharma, said recently that the AI boom now checks every box on his 4-part classic bubble checklist. He drew a specific comparison to the late 1990s telecom boom, where companies laid millions of miles of dark fiber in anticipation of exponential bandwidth demand. Today, we're building GPU cluster data centers at the same frantic pace. And a study this year found that despite 90% of firms reporting no measurable AI impact on productivity yet, the spending keeps accelerating. The gap between investment and returns is real. And fourth, the valuation metrics are flashing amber. The Schiller-Cape ratio started this year above 40. That's only the second time in history it's been that high. The first time, right before the dot-com crash. And then the market gave us something new. $1.4 trillion gone in a single session from AI chip stocks alone. Broadcom was down 12.6%, Marvell down 17%, AMD down nearly 11%. If you want a live demonstration of how fast sentiment can turn in this sector, June the 5th, 2026, that's your case study. Now, before you go and sell all your tech stocks, let's look at the other side, because the people saying this isn't a bubble also have a very strong argument. And interestingly, the sell-off actually gives them some ammunition too. The strongest argument, by some distance, is this. These companies actually make real money, extraordinary amounts of it. Pets.com had no earnings. Cisco was priced at 200 times earnings. Many dot-com darlings were burning cash with no path to profitability whatsoever. Nvidia posted net income of over $120 billion in the last fiscal year, revenue of $215 billion, gross margins of 71%, net margins of 53%. These are amongst the most profitable financial results in the history of capitalism. This is not a company held up by hype. It is printing money at a rate almost no company in history has matched. Second, the big tech companies are spending what they earn, not what they borrow. In 2000, the ratio of tech capex to free cash flow peaked at nearly 4 times. Today, that ratio is below 1. These companies are funding the AI build-out from genuine profits. That is a fundamentally different financial structure to the dot-com era. Third, the valuations, while high, are no way near dot-com insane. Cisco was at 200 times earnings in 2000. Nvidia today is at less than 50 times. Microsoft, Alphabet, Amazon, all below 30 times earnings. Elevated, but not unhinged 1999 territory. And fourth, look at what happened after the sell-off. By Monday, the 8th of June, the Nasdaq had recovered nearly 1%. Nvidia's CEO came out and called the dip a buying opportunity. Analysts pointed to continued data center expansion and the emerging custom AI chip market as long-term drivers of growth. The market reassessed rapidly and concluded that the fundamentals hadn't changed. That's not how bubbles behave when they pop. The DeepSeek moment last year is the clearest example of this. 588 billion gone in a day, almost all of it back within a week. You could read that as dangerous fragility, or you could read it as the market rapidly concluding that cheaper AI probably expands the market rather than kills the leaders. So where does that actually leave us? Here's my honest take, for whatever that might be worth. I don't think we're in a dot-com style bubble across the board. The core AI companies are profitable, growing fast, and genuinely changing the economy. The technology is real. The revenue is real. The capex to free cash flow ratio is below 1. They're not borrowing to build, they're investing profits. That is fundamentally different from 1999. But, and this is a meaningful but, I do think there are parts of the AI market that are in bubble territory. The fringes, companies that have added AI to their pitch deck and seen their valuation triple. Companies with price to sales ratios of 80, 100, 120. Palantir entered this year at over 100 times sales. That is speculative territory, regardless of how good the business is. And last week illustrated exactly where the fragility lives. When the sell-off hit, it didn't discriminate neatly. Real companies with real earnings got caught in the same wave as speculative names. That's what happens in sectors where sentiment is stretched. The pullbacks are indiscriminate. The question is whether you're holding companies whose fundamentals can justify the wait. The most useful distinction I've come across is between a stock bubble where prices have run ahead of earnings and a fundamental bubble where the underlying earnings themselves stop growing. Right now we might have stock bubble conditions in certain names, but the fundamental earnings story for the core AI leaders is still intact. Bubbles pop not when PE ratios are high, they pop when earnings stop growing. For the genuine AI leaders, earnings are still growing fast. And here's the part I keep coming back to. Amazon fell 90% during the dot-com crash. If you'd bought at the peak and just held it, you'd have made life-changing money. The technology won. The investors who panicked lost. In recent market events, Nvidia fell 6% in a day. It was down, and then it started coming back. That story should sound familiar. Right, all of that is interesting, I hear you say, but what does it actually mean for your money? First, if you're invested in a diversified index fund, you already have AI exposure. A global index fund or an S&P 500 tracker already holds Nvidia, Microsoft, Alphabet, Amazon, and Meta. You don't need to make a specific AI bet. The flip side, when AI stocks correct, as they did recently, your index fund feels it. That's worth understanding rather than being surprised by. Second, be very cautious about the fringes. The pure play AI companies with no real earnings, sky-high valuation multiples, and business models that basically amount to, we use AI, that's where the genuine bubble risk lives. The recent sell-off was indiscriminate, but in a real correction, the fringes get hit hardest and recover the slowest. Keep speculative AI positions small and ring-fenced. Third, zoom out. The question, is AI in a bubble right now, is a short to medium term question. Over the long term, it's almost certainly irrelevant. AI is going to be transformative. The companies leading it are almost certainly going to be worth more in 20 years than they are today, even accounting for corrections along the way. The dot-com bubble destroyed people who were over-concentrated in speculative tech. It made money quietly, eventually, for people who owned diversified portfolios and just held on. Recent events have been uncomfortable. It wasn't a signal to panic. It was a reminder that this sector moves fast in both directions, and that owning it through a broad index fund rather than making concentrated bets is the sensible way to stay in the game. So, is AI the next dot-com bubble? Honestly, parts of it probably are. The fringes, the speculative stuff, the companies riding the hype without earnings to back it up. That's got bubble written all over it. And the recent $1.4 trillion single day sell-off was a timely reminder of how fast things can unwind. But the core AI leaders, the ones generating real revenue, real profits from this technology, are in a fundamentally different position to the companies that drove the dot-com crash. They're not pets.com, they're more like Amazon. Possibly overvalued right now, definitely not going away. The lesson isn't sell everything tech related, it's own the real stuff, stay diversified, and don't lose your head over the hype on either side of the argument. If this week made you nervous, if you watched the headlines and felt that familiar knot in your stomach, drop a comment below, bubble or not. Anyway, share this with someone who's been confused about the AI noise. All right, legends, subscribe if you haven't, and I'll see you in the next one.